Welcome to Tax Insights, presented by Hawkins Ash CPAs.
And good morning, listeners. Welcome back to Tax Insight here on WOMT. We're talking with Jeff once again this morning. Jeff, good morning.
Good morning, Terry.
Business tax planning for 2021.
Yes, because you remember last week we talked about tax planning for individuals.
Yes.
Kind of based off of some of the changes that might be happening in Washington. So today I thought, why don't we talk about the business side of tax planning? Just like individuals, this year may be the time that they may want to recognize some income and delay deductions, which is definitely different than what it is in a normal year.
So there's going to be changes to income tax rates, correct?
Right. So since many small businesses are set up in a way that their income kind of flows onto their individual tax return, the individual tax rate increases that we talked about last week will apply to business income as well. And some of those rates, those increases might be 7% or more.
Wow. What about businesses that pay their own taxes?
Yeah, so these are C corporations, and they're looking at tax increases from about 21% to the proposed rate right now is 28%, and there might be an addition of a minimum tax.
So I know last week we talked about the qualified income deduction, and I understand that there may be changes to that would affect business income as well?
Right. So remember, that's that 20% business deduction based off a certain business income. The proposal in Washington is looking to limit this deduction for higher income business owners. So this would go hand in hand with those corporate tax increases that they're looking into.
So those are good reasons to have a higher income this year, but what about businesses who are looking to decrease their income?
I still think depreciation and retirement planning are probably still your best ways.
So let's start right there. Talk about depreciation.
Okay. So, when a business purchases an asset that may last longer than a year, they need to take that deduction over that asset's useful life. But depending on the business, they may be able to elect to take the entire deduction in the first year. This is the Section 179 deductions that many businesses are aware of. So I bring this up because normally a business could wait until December to buy an asset. As long as they started using that before the end of the year, they could take the deduction. But look where we're at right now. This time of the year with product shortages, many manufacturers, I think, are going to need a longer lead time in order to get the company what they ordered. And remember, if that asset is not used or placed in service by the end of the year, they can't take the deduction. So some of these businesses, I think, are going to need to start planning for their assets a little earlier than they have in the past.
So I know you also mentioned something about retirement plans. Tell us a little bit more about that.
Yeah, so contributing money to your retirement plan and doing matching contributions for your employees is always a great way to save on taxes. There's a ton of different plans out there, and it just depends on what plan fits best with that company. Maybe what we'll end up doing, Terry, is maybe we'll talk about retirement plans next week since there are just a whole bunch of different types.
Sounds like a plan, my friend. In the meantime, how do listeners connect with the team at Hawkins Ash?
You can go right to our website, which is hawkinsashcpas.com. Follow us on Twitter or like us on Facebook.
We'll talk to you next week.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.